Why hasn't the stock market crashed yet? That's my question to you. And my guest was a former stock trader, had trading programs that he offered, was a financial advisor, did the same thing I did, let his licenses go to pursue the truth. What's going on, everybody? Welcome back to the Money School podcast. This podcast is all about, well, you guessed it, money, but it's about taking back control of your money. It's about the truth when it comes to money, not all the fluff, not the media, the absolute deep down truth about how money works. And that's what we're going to be talking about today. But we're going to talk about a lot of things, but I want to ask one specific question to the audience before I introduce my guest. Why hasn't the stock market crashed yet? That's my question to you. Well, we're going to hit on that. And my guest was a former stock trader, had trading programs that he offered, was a financial advisor, did the same thing I did, let his licenses go to pursue the truth. And that's what we're going to talk about on this episode. Chris Miles is my guest. Welcome, my friend.
Hey, it's like the show of Chris Squared, isn't it?
Chris Squared. Absolutely. So today in this, I want to talk about the Trump effect. I want to talk about what your thoughts are about why the stock market is where it is and how people can protect themselves or not protect themselves, whichever way they want to go. I definitely want to talk about privatized banking and the infinite banking concepts, because I know that's your specialty in your field, and you found your way from advisory into that as well, just like I did. But audience, like, you got to pay attention to today's episode, because this is going to be very timely, very important, and I don't know how much longer you got, but you're going to need to hear what Chris has to say. And he's somebody you should listen to, because he's been featured in U.S. News, World Report, CNN Money, Bigger Pockets, and so many other media outlets. So, Chris, why has the stock market not crashed?
Well, it's because there's money supply. That's why there's still money. All right. I mean, that's really the biggest thing I've noticed that you see throughout time, is that it's not about what Tesla is doing. It's not about what Trump tweets necessarily, although that does affect it day to day, right? But what it's really about is there still money in the economy, right? Because as long as there's still money pumping in, there's still a reason to keep the market up. Now, understand this. That's more economic. Economics and markets don't follow the same rules, right? Like the stock market is all based on projections, right? It's always fear and greed based. It's always based on what we think is going to happen in the future. So even when I was, trading stocks and options and stuff before, and teach people how to do that, the problem was this, is that I would tell people, I was like, listen, if you're learning about this stuff, you're not an investor, you're a gambler. Because the truth is, you'll never truly get it right in the stock market. No matter how good of an analysis you think you do, no matter how good of analysis, not just on the fundamental side, but the technical side you do, you're going to be wrong at some point, right? So you just have to minimize those losses as much as you can. I mean, you're literally guessing, and you're guessing based on odds. And so the biggest thing we would look for, of course, economically speaking, if we're looking at the economy, the health of the economy, it's based on exchange. How fast is money exchanging hands, right? Is there money? And what's happened, think about this. I mean, even lately, Trump's kind of going back on his word a little bit, right? Like before, he's like, we're going to clean house. We're going to like doge it up, right? So to speak, they're going to have Musk coming in and just making everything just dirt cheap. And then he comes out with a tax bill saying, hey, by the way, we're going to go like another $3 trillion in debt or whatever, or even more, right? And the reason he's doing that is because if he doesn't, then the money supply will dry up. And then, yes, the market will tank. And guess who gets blamed, right? The economy will slow down. And so what we've had in the last 5 years is this everything bubble. Everything, even real estate, has got bubbled up so big, right? Now, I'd say real estate's a little bit less than the stock market. Stock market's like over 200% of its valuation, what it should be based on the Buffett indicator. If you ever look that up, it's kind of cool. But it's like way higher. But what we're seeing, even when real estate too, like everything's been inflated up. That's why so many people are like freaking out about affordability. At some point, yes, people can't keep spending money, right? They're trying to, but their corporate raises aren't going up nearly as much as what we've seen inflation do. And by the way, the whole 2.5% crap, like we all know that's not true. Go to shadowstats.com. You'll see the real inflation rate's about 6 or 7% higher than whatever's reported, right? And so that's what's happening. But again, if banks are still lending, and this is where it comes in, the financial institutions, if they're still pumping money out, if the feds are still throwing money out there, which they are, like they started to slow down a few years ago when they were raising interest rates, but all of a sudden they started to prop it back up, right? They're still pumping money in, which is creating, again, inflation, deflating our value of our dollar and everything else. And so there will be a point where, as they say, the bigger the party, the bigger the hangover, right? Like there is a point where there will be a bigger hangover, there will be a reckoning. And one of two things will happen in the stock market. One, we'll see it correct very quickly, sooner than most people will realize, but then come back slowly, right? So what we're seeing right now, like the market in June, we're seeing the market getting back, like the SP back up towards 6,000 again. Well, here's the deal, is that this is getting up near the previous high. Did you know before Y2K, the year 2000, I remember because this is when I was entering the financial advisor world. In the year 2000, March, it hit a high, then it dropped, but then it kind of came back up again. And then right at August, it got right up to where it was again. It hit that line of resistance. And then bam, it pops back down. We saw 2 years, all the way till March of 2003, the market just tanking, right? And then, of course, the market started to recover again. And right when it got up to that previous high from March and August of 2000, right when it got to that previous high in 2007, what happened? Market drops again, right? And so it took 13 years before the S&P actually got back up and broke that previous line. And I'm not saying that's what's going to happen now, but that is one possibility, is that it's right up there right now. You might be at the perfect place to capture all your gains. Like what I taught people when I would trade stocks is, take your wins, capture your gains. If you've been in the market for the last 5, 10, 15 years, you've seen insane gains that have not been seen in history of the market. And so you can capture those gains if you wanted to, take them out and say, great, now I've got cash, or even move it into something more conservative, right? Again, we're not giving advice on this show. I'm not securities licensed anymore, but you have options to not be full on hardcore in equities, right? You could get that money out and move it over. And so the cool thing is this, is that like you're right at that high. Now, could it go higher? Maybe. But here's the thing, even Vanguard, even they're predicting the next 10 years is only a 3 to 5% average roughly. So if you think about that, that's an average per year. It's possible you could keep your money in CDs for the next 10 years or in an infinite banking policy for the next 10 years and make more money than you would in the stock market and have less risk.
You nailed it right there. And I've never had somebody on this show say what you did, because everybody's this eternal optimist. Everybody thinks that the markets are just going to keep going higher. Real estate's going to keep going higher. Like we live in a very strange time. One that if you study history and you go back to the Roaring 20s, the sentiment during the Roaring 20s was very similar to now. But not only was the sentiment similar, and just if you all need to know what sentiment is, it's just basically your good and warm and fuzzy feeling about how the market and the economy are going to do. But not only that, they were borrowing massively to take leveraged bets in the markets. Like margin was one of the number one things used back during the Roaring 20s to buy stocks. They weren't using money they had, they were leveraging. And what are people doing today? Leveraging, maybe a little different, maybe not using margin to buy stocks, but they're leveraging their lifestyle with credit cards, with massive amounts of loans. And Chris, I don't know how much you follow the reports and the delinquency reports, but dude, that's a scary picture. So, when we talk about like Buffett, and listen, I've read Graham's books. I love Buffett and Munger's, discussions. God bless Munger. He's no longer with us, and Buffett is actually planning his succession and step down. So we're kind of coming to the end of an era of what I would call the 3 greatest investors of all times, and they weren't even the greatest investors because of any kind of technical things or super fancy dancy stuff, but because they literally focused on the one thing that I would say 99.9% of all investors have forgot, and that is reality and fundamentals. Like Munger and Buffett, they read books, they read reports, they read about a company's fundamentals, and they looked for opportunities inside of a company. And every company has opportunities because every company, when they grow, things get left behind, or companies get to a certain size where they just have kind of lost their way. I know this, I've been in businesses like that, but what Buffett and Munger were very good at doing is looking at a company's fundamentals. Like the fundamentals, folks, it's just they'll look at their balance sheet, they'll look at their financials, they'll look at the profit and loss, the cash flow. Most investors don't even look at this stuff anymore. They look at technical indicators, they look at all sorts of charts and everything, but that doesn't tell the real story behind the surface. And that is why Buffett and Munger, Berkshire, has literally been one of the most successful investments period. I think in all of history, and Warren will go down as the single greatest investor of all time. No ifs, ands, or buts about it. And the thing that I love about Buffett and Munger as well, I'm reading a book right now about Munger, is their simplicity. And you mentioned it a second ago, what you taught in stocks. Buy low. Okay, simple thing. You can look around and you can buy low. But here's what people don't do is the next and most important thing: sell high. Folks, we've been at this high point in the market, and Chris just alluded that we're approaching the high again. So what should you do just by pure logic? You should sell and take your gains. It makes all the sense in the world. But then you find a million reasons not to. Oh, well, I think it could go higher, and NVIDIA's got this, and you start getting into all this speculative shit that doesn't mean anything from a fundamental basis. And I want you to talk a little bit about the Buffett indicator, because there is not one, just so you all know, and I could be a little off on this, but there is not one stock in the entire market right now that fundamentally makes any bloody sense. Am I wrong in saying that, Chris? Because I'm just going off the cuff on that one.
Not at all. And if someone's looking for more evidence about why they may want to go more in cash, look at what Buffett's done since really 2023. He's been cashing out.
Billion and counting.
Yeah, 347 billion, I think was the last number I saw, right?
Damn.
I mean, it just keeps adding up, and that's the thing is like he's getting liquid right now. And that's why I tell people, like, ever since 2020, when I saw we were expecting, I remember in 2019, we were talking about an actual recession starting in 2020. And then with COVID, it's like, oh, here's the black swan event. This is it. This is finally going to put us in that recession. We're going to finally see the market go down. But it didn't, because they started pumping so much money into the economy, right?
$5.3 trillion. Nobody listening to this, and nobody I've ever met understands the magnitude of how much money that is. They have no physical conception of how much money that truly is. Matter of fact, they still haven't spent it all, and they have been trying to give it away, and it's not gone. That's how much money it is.
That's right. And it's like you blow a little bubble. If you ever remember like the bubble gum days, I mean, I do. I don't know how many people chew bubble gum anymore, right? But you blow that bubble, but then you're like, I'm just going to keep going. And then it pops and it gets in your hair and stuff. You have to use peanut butter to get out.
Chew. Remember the package you tore the top off? It was like, like dip, but it was like gum.
Oh, yeah.
You could
it was like the kid dip, I totally remember that.
Good old days, man.
Yeah, so like that's kind of where we're at right now. And so again, like there's all that money going in, but Buffett's getting liquid. And I've been telling people, get lean, get liquid, and get out, right? So like get lean means really be a wise steward of your money. Watch what's going on. Like do not get overly careless in how much you spend, but also make sure you're finding ways to create more income too. So make sure you're getting, more lean that way, that you're living well within your means, creating more money, but also being responsible in your spending. That does not live on rice and beans, because Dave Ramsey's full of crap that way.
Dave Ramsey's pretty much full of crap, period.
Yeah, pretty much.
He's got a great little concept, great little thing that help people get out of debt, and kudos to him. I love him for that. But why can't he just stay in his lane? Why does he have to, he gets a client in his little baby steps, which is fantastic. The envelope thing, I love it. I love the concept of it. But then when they do get out of debt, then he brainwashes them. Here's my analogy of Dave Ramsey and his clients. You get into Dave Ramsey's program, you're like a bird that has a broken wing. He puts you in a cage, he mends you, he feeds you, he gives you all the things, like the best environment. And you're this little bird that was hurt, and now you're good, you're mended. You want to go out and fly free again.
Yeah.
But he wants to just keep you in his little cage, and he refers you over to his band of married advisors, which all those people are, folks, are financial advisors that pay his sorry ass to be called the Dave Ramsey, whatever he calls them. They're probably not even good advisors, because Dave and his magical returns that he talks about in his show all the time of 12% in mutual funds, I'd love to know where he's getting the analysis to say that these mutual funds he's recommending are 12%. You ever hear him talk about that? I'm like, dude, how has he not gotten in trouble for that? So what are your thoughts about Dave Ramsey and his little scheme to keep people trapped into his environment?
Like you said, he's blessed a lot of lives. There's no doubt. He can get people to zero. It's just getting people past zero is when it falls apart, right? This is the thing. I don't believe that scarcity and money should be taught together. That's one of the biggest issues I have with Dave Ramsey, is that it's always about scarcity. There's just never enough. You just got to scrimp and save and sacrifice and suffer all your life. And the problem is that people create those habits and then never get out of it. Because I'll tell you, our our typical clients that we have are always, I mean, whether they're W-2 employees or they're business owners, right? Like if they follow that method, eventually get to a point saying, wait a minute, I'm worth a couple $1,000,000, but I have nothing to show for it. I have no income, right? Like I am asset rich, cash poor. I am still trapped in that cage, as you mentioned, right? Like I'm still trapped in that. And I think that's the big difference, is that instead of trying to do that, I talk about get lean, get liquid, get out, right? Like getting lean, sure, he talks about that, but he goes a little extreme on it. Getting liquid is have money in cash available, whether it's in just savings, whether it's in your brokerage account, whether it's in like infinite banking, it doesn't matter. You're liquid, it's available, and it's safe. And then the thing is to get it out. And that's the thing he misses. He doesn't get the money out into things that actually produce passive income and cash flow. It's always accumulation mentality, not acceleration mentality. And if you can get past that and you can realize, by the way, again, coming back to evidence, right? I always like to look like, where's the evidence? Look at his net worth. And I've tried to find it everywhere. It's very unclear how much he actually has of his own money in the stock market. But what is clear, though, even though it's been debated about whether he's a billionaire or not, I know there's some podcasts that interviewed him recently say he's a billionaire. He's not even close. From the evidence I could find, he's worth roughly about $200 million, which is amazing, by the way. But here's the thing. His company is arguably worth about $52 million. The rest of it, $150 million of that, is real estate. So shouldn't we just do what worked for Dave Ramsey versus following the crappy advice he's given, which he's not apparently following himself, right? That's what we should be doing.
Well,
That's my opinion.
I heard some very factual information, and I don't have the source, so I want to be careful what I say. But Dave Ramsey, who hates whole life insurance and openly has no clue how whole life actually works, especially designed and engineered whole life. But nonetheless, I've heard from the horse's mouth, he actually owns whole life insurance himself.
Of course.
Unreal. Yeah. Like that just right there takes all the credibility away from him. Like you practice what you preach, and he preaches buy term, invest the difference, but yet he's living a different life. And that is just not okay by me. And I was so upset when I heard that. I wasn't upset that he owns whole life. That actually makes all the sense in the world. I was upset that he would never admit that in the public, because he's literally created this little moat and this little wall around himself that doesn't allow him to be truthful with his folks. But let's get off the Dave Ramsey topic. I want to go back to what you said a little bit ago, because the one thing I can tell everybody on this audience is we are in a very unique period of time for a lot of reasons, but a very unique period of time, because in this time you have a very rare opportunity that I don't think I've ever seen ever in my professional life, or in professional career, where interest rates are at a relatively high point. You can get paid for sitting on the sidelines. Hell, you can sit in a FDIC insured bank account and make 4%. Heck, you might even be able to get closer to like 4.3% if you really went out and looked for it. So that's a bank account. In treasuries, you can get T-bills that are paying you mid-4s, because that's what a bank is guaranteed. If a bank's paying you 4%, they're buying T-bills to back that bank account. That's what they're doing. There's no magic secret. They're making a razor-thin little margin, but they're making money. You could buy long-term treasuries right now, which I arguably think is one of the smartest things anyone can do, because I have never seen treasury bonds get beat up, long-term treasury bonds get beat up like they are right now. I mean, what Trump's doing, with what the dollar's doing, with the downgrade by Moody's and all the other rating agencies downgraded prior, like treasury bonds are at rock bottom price. So again, back to Buffett, buy low. The epitome of buying low is a literally, arguably a risk-free asset, a risk-free investment, because it's backed by the full faith and credit of the U.S. government. And I know I've heard this, Chris, and I want your take on this. People have literally told me, they're like, well, yeah, but what if the U.S. goes bankrupt? I kind of laugh, because that's physically impossible, because the U.S. debt holds debt in U.S. dollars. The U.S. debt literally can print more U.S. dollars. Not saying that's a good thing, because it devalues the dollar, but they can't go bankrupt when they control the currency that the debt is issued in. Do you understand that, folks? It's a physical impossibility that the U.S. goes bankrupt. So it's almost an impossibility that you wouldn't get paid for your investment in treasury bonds. I hope that sinks in. But because you can buy them so low, and then the next thing, and Chris, I want to talk about what they say inflation is, which the last report that the Fed came out said 2.3%. Now, I know it's way higher than that, because they exclude all sorts of the important stuff, but 2.3. The Fed's target since back when they started fighting this dragon that they created is 2%. So there's no question that we're going to hit 2%. And I know there's some people out there, oh, the tariffs are going to make it inflationary. Go back in history, please, 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 and tell me one other time where tariffs, because they've been used a lot, have been inflationary. It isn't going to happen. It might increase prices slightly a little bit, but it's not going to be an inflationary push. And you know what? The proof's in the pudding. We've been going down in inflation while the treasuries or the tariff claims and the tariff shenanigans have been at all-time highs, really, if you think about it. So there's your debunking of that. So if we hit 2%, I've researched this, the Fed is going to more than likely ease their monetary policy. They're more than likely eventually going to drop interest rates. I think they probably already should have, but they're eventually going to do that. And when they drop interest rates, treasury bonds by sheer mathematical nature go up in price. That's a good thing if you own treasury bonds. But the other good thing about owning treasury bonds is right now, because of all this stuff going on, treasury bonds, long terms, I mean, the 30-year was over 5%. Dude, I don't know any other period of time except for the 80s and early 90s when treasury bonds were paying that. So all I'm trying to say is, like, this is like a rare bird where you get paid for taking no risk. Yet the majority of Americans, through their 401ks, investments, and financial advisors that are steering people completely off of a cliff, are telling people to go into risk assets like stocks because of the Magnificent Seven and the S&P 500, which is literally being driven largely by 7 stocks. 500, S&P 500 means 500 stocks in there, and 7 of them are the only ones that matter. And you're going to tell me that's your bet? Dude, I'm sitting on the sidelines. And then we're going to take this and we're going to go one step further, because who is one of the largest holder of treasury bonds out there outside of other countries? Giant mutually owned insurance companies own them because they know something that we all should know. And where can you get exposure to the returns without any of the volatility or the risks of treasury bonds? We're going to hit that, folks. We're going to talk to you about that. But Chris, let's just unpack a little bit about that little rabbit hole I went down with treasuries, T-bills, and where we're at in risk-free assets sitting on the sidelines.
Yeah, you mentioned about people being afraid of the U.S. dollar, right? I mean, that's the biggest fear, and it's a good fear to have.
It is.
But,
I agree.
But understand, I heard that same fear in the great global financial crisis, right? Because you got to understand, most of us Americans just have this myopic view, right? We see only things from a U.S. lens. You don't realize that Europe, they're failing even worse than us, right? There are so many other countries failing. China is in a massive depression right now.
Screwed.
Yeah. I mean, they're horrible. I mean, they're in a horrible state right now because they don't even have enough people to even fill what's going on over there. And so everybody's like, oh, you got to invest in China.
Just on that, I don't mean to interrupt you. Yeah. Not only do they have a major demographic problem, they don't have enough people to support the growth that they need to even survive. Who in the world wants to move to China? So they don't have immigration. Like the United States, we have a little bit of a demographic problem because it's so expensive to have kids, but we've got a massive amount of people that want to live here because this is the land of the free, the greatest country on earth. We as Americans have just forgot that. That's all there is to it.
Yep. Yeah, we're not tariffing the people that are immigrating in from China. That's the thing. Like, we're bringing in more people than our people are going over there. And I think that's a key distinction. That's why they're begging for workers, right? And again, you'll never hear President Xi, or however you say his name, like, you'll never hear him say, hey, you know what? We're struggling right now. Our economy sucks. He will never say that, So that's the thing. And you mentioned something too. Like, if you look in history about tariffs, you're right. Like, I remember one of the things that put us deeper into the Depression, even though we're trying to pull out of it, one that put us deeper into depression is the Smoot-Hawley Act. I mean, look that up. That was when we were trying to be, this sounds familiar, buy America first, stop importing goods, tariff everybody else, right? And what happened? We still had a deflationary environment during that Great Depression, right? And so yeah, don't believe that, that tariffs can always be inflationary. That's not always the case. It can actually backfire and hurt us more by having tariffs in a different way. So just be aware that everything is about flow of money, right? And anything that stops money from flowing in, and this includes trade between countries, and this is where you could see the stock market get affected too, is that if it does prevent more trade and exchange of money and services and goods, that slows down an economy. And if that slows down the economy, they start laying off people. and they start laying off people, then they don't have money, and then they can't start spending. If they can't keep spending, then of course, pretty soon you get laid off, because then you're losing your job, right? You're getting downsized. And so that's the thing. It's always about that flow of money. If money's flowing, things are fine. But once that stops, that's when you start to see, like, it's like sticking the stick in a bicycle spokes, when you're riding and somebody sticks stick. I did that to my sister once, and she flipped over the handlebars, and I realized, oh, it's just like Indiana Jones, but not funny, so don't do that, by the way. That's a disclaimer there.
Oh my gosh.
Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action, like so many others have, by going to privatemoneyclub.com and sign up.
So, audience, I want to just it's very easy to get very negative right now. I mean, look at everything that's going on. You got the threat of all these tariffs, and you got the, what do they call it? The taco effect with Trump, where he says one thing, then pulls it back, then says it again, then pulls it back. I mean, are they closing TikTok down? Is it going to be sold? Then nothing about it. Epstein files, are they going to get filed? Are they not? Well, now with Elon, who the hell knows? You got all this stuff going on. You got delinquencies on credit cards and car loans and mortgages on a rise. You got the commercial real estate mortgage world literally about to go off of a cliff. Those defaults are like a straight line up. You've got China, who right now is kind of arguing with Trump about this trade, deal and the trade deficits. But not only that, I think if you've been paying attention, you got China eyeing up an attack on Taiwan, which is probably imminent. That's going to happen. And if that happens, I hate to say this in public, but that means World War III. No ifs, no ands, no buts about it. If China were to attack Taiwan, the U.S. will retaliate because they are one of our biggest allies. It will be all-out war, and the U.S. and China will be at war. I hate to say that, but just know that's the barrel you're looking down. So as you look at all this information, if you choose to look at it, it's not hard to get scared and crawl under a rock, but I'm going to pull you back out of the rock, and Chris is too, because there's something that both Chris and I learned a long time ago, something that we literally as advisors would have fought against, something we would have pushed back against because it was against the grain, against what we were taught, and against everything we knew about the insurance industry and whole life specifically and how it works. But when we learned about this thing, which is commonly known as the infinite banking concepts, also AKA privatized banking, if you go back into the old days of what the wealthiest families called it, everything that we do with the infinite banking concepts, which Chris also teaches thousands of people about the infinite banking concepts, just like I do. So, this is a perfect example that in our little ecosphere of the infinite banking world, we don't have competitors, we have allies. Chris does the same thing I do. But I will tell you this, in light of all the noise out there, all the fear, all the negativity, it is so calm in here. Because the one thing I will tell you that we're going to dive into next is when you learn how the infinite banking concepts works, which is a process that allows you to take back the banking functions in your life. And when you learn the machine we use, which is none other than a specially designed, and you got to key in on that, specially designed and engineered whole life insurance policy from a mutually owned company that pays dividends, it doesn't matter how wild and noisy and scary it gets out there. It is so calm and peaceful in here. And the only thing we do every day is sort of laugh, because we literally sit back and we just wait for opportunities to be presented in front of us. We don't have to ride the roller coaster anymore. So Chris, how did you first, because I've never heard your story, how did you first get turned on to the infinite banking concept?
Yeah, it was that I was actually I was kind of against it at first.
So was I.
Because, I started as a financial advisor. I did that for 4 years in the early 2000s. And then in the mid 2000s, I realized when I sat down with my dad, he was 61 years old. He was the penny pinching saver. He was like the guy that Dave Ramsey would look up to, right? Maybe Dave Ramsey learned from my dad, in fact, because my dad had that Depression era mentality. But when I sat down with him, I said, Dad, despite being debt free, paid off house, you've stuffed money in your 401k for the last 20 years. 401ks only got available to mid-Americans about 1985. So you'd done that for 20 years. He was getting the match and everything. I said, Dad, even though you're 61 years old, if you try to retire today, you're going to need to die in about 5 or 6 years because you'll run out of money, despite being the perfect saver from what everybody was teaching out there. And when I realized I didn't have an answer for them, that's when I started looking outside of that. And that's why I started finding like real estate investing, right? And realizing that it was about, cash flow, not about accumulation. And so as I was doing that, I'm meeting these guys, all these real estate investors here in the state of Utah. All of a sudden they started talking about this infinite banking concept. And I was like, I've never heard of that. What are you talking about? They're like, yeah, we use whole life insurance. I'm like, hold on. Whole life insurance is like the worst thing you could possibly do. Because I had sold insurance. I even sold like variable universal life. But then I realized Y2K, that wasn't so good. So then I started going more like index universal life. I was selling that. But then after I was training other agents, like new agents on index universal life, they'd say, hey, what happens if the market does this? Oh, yeah, that's bad. Hey, what happens if they change the cap rates? Oh, that's bad. Oh, what happens to this? But by the way, this has all happened in the last 20 years. And so I started to realize there was weaknesses there. But then I hear about whole life, which I was told only pays you 1 or 2% a year is what I was told. I didn't know anything for certain. And so I met with a guy, one of the partners of a mutual friend of ours. And I sat down with them and I drank the Kool-Aid because apparently all these real estate investors love it. They say it's the best thing since sliced bread. You go and buy cars and houses with it or whatever. So I got it. 2 years in, like that was 2006 when I bought the policy. 2008 rolls around, I'm going broke. I went from millionaire to upside down millionaire because after I was able to retire when I was 28 with the passive income I had from real estate, when the recession hit, and then I was starting this new business with that other partner and stuff, next thing I know, I'm in the hole like $16,000 a month. So I couldn't afford to pay my premiums. It was a pure base only type of policy. So I bought a mass mutual policy, but it was expensive. I mean, it was like $1,000 a month, but I paid 25 grand into it, but I had zero cash value into that policy at that point. So when I couldn't pay the premiums, I lost it. Now understand, I had asked this agent, I said, hey, I know I could do this with universal life. Aren't there certain levers I can pull to make this a little bit more cash rich up front? The agent said, no, you can't. If you do, you'll get taxed. I said, well, I hate taxes, so let's not do it. I found out later, and we have a mutual friend, Patrick Donahoe, that bought a policy from the same guy. Patrick decided to get his insurance license, and we're starting to compare notes and found out that this agent did lie, that we could have pulled some different levers and made it work. And so I remember I got that guy in an office, and I started yelling at him for about 2 hours straight, debating him, saying, look, I ran my own numbers because I still kept my insurance license, right? I just didn't know how to design it until I decided I'll do it on my own. I started showing him the numbers, and finally he just said, Chris, I designed it that way because I couldn't afford to cut my commissions.
Wow.
I said,
so he told you that.
He finally, because he ran
Good
out.
for him. It's too bad it took you yelling at him.
Like, well, cool, I matched your death benefit. What else he got? I'm like, still, I have more cash from day one. And in the end, like the cash value was relatively the same. I still had a little bit more than him. But it's like, the important thing is, because all of us are having this cash flow crisis right now, having cash up front in the policy, right? And even that time, like I was like, dude, if I can even get 50, 60% up front, that's incredible, right? I didn't know that was even possible. And so when I showed him that, he's like, yeah, I just couldn't afford to cut my commissions. And which is ironic because he was the one that was always talking about abundance mentality, right? And you do what's right for the client. I'm like, well, if you do what's right for the client, you know how many of your clients wouldn't have canceled their policies or lost their policies over the last several years? Your surrender, percentage is super high because of this. And so anyways, after that, I said, I vow never to send you business again. I sent my friends and family. I couldn't trust him because I knew he was only looking out for his own family and not for the people from my own family, essentially. Wow. And that's kind of where I went down the rabbit hole and been doing what I've done really for the last 17 plus years.
That is interesting. And that is a story that I'm sure you hear a lot still to today. And I hear it more now than ever because infinite banking concepts is sort of getting a little bit of a mainstream name. People are getting used to it, hearing about it. But it's also attracting a lot of the bad apples from the advisory world who are looking for some quick money. So the folks in the insurance world, the normal agents, the broke-ass brother-in-laws, if you will, they're hearing about this thing and they're like, oh, wow, we do it. And a friend of them says, hey, I heard about this infinite banking thing. Oh, we do that. Great. Help me out, set me up. And they set people up with a policy like I've seen some of the most horribly designed whole life policies. Now listen, all whole life policies are good, but like you said, the ones that are designed for high early cash value, like what we design, make a massive difference because you can get so much further ahead right out of the hole. Like literally immediately in the first 30 days is the liquidity. Like you put money in one of the policies we designed, it has liquidity immediately in the first 30 days that you can use to pay off debt, buy a car, buy real estate, do lending on real estate, anything you want. But the policies that we were sold and that I used to sell as an advisor were the ones like you talked about, the normal base policies where the commission is greatly increased to the point of 60 to 90% more than the policies we write today. They have no cash value in the first year. I did a presentation last night. I showed an original base only whole life. There's no cash value in year 2. In year 3, after the person put $30,000 in, it had $2,400. Imagine that. You put 30 grand into something and you have $2,400 available after 3 years. Is that a good place and a good use for your money? No, but that is what the majority of life insurance agents and advisors will sell you, because one of two things. Number one, they don't know how to design them like we do, where they have immediate high early cash value. Or number two, like your guy, they just can't afford to give up 60 to 90% of their commission so their client has 60 to 90% more cash value. Now, I want to dive into this because right now I feel like I guess I'll pat ourselves on the back, myself and yourself. We are in a perfect place at the perfect time. The markets are on the verge of a meltdown. I can't see how they could push higher based on the economic data that's coming out and the jobs reports and everything else. So I think we will touch those highs again, but I don't think there's a single chance in hell that we're going to punch through the resistance and go higher. It'll bounce and probably either stay in this channel, which is a sideways market, just as bad as a downward market, or we'll continue to go down, and then that one domino will go and the whole thing will let loose. At that present time, inside of these specially designed whole lives, your money is guaranteed. The dividends are not, but your cash value grows guaranteed. And the insurance companies have never, ever missed a dividend payment. And I mean, the ones we deal with, I mean, some of them over 160 years consecutively, through the Great Depression, through the Great Recession, through the Y2K.com crash, through COVID, always paid a dividend. So imagine that. You don't need to worry about any volatility. Your money will be worth more than it is today, next year, and the year after, and the year after, and it will compound and go faster and faster. And all you need to sit back and do is either learn about the investments you know, like, and understand, or wait for the opportunity to pounce. Real estate values are going down in Sunbelt states right now and will continue to go down. Apartment buildings are suffering tremendously because they missed the mark, and they decided they were going to build only luxury apartment complexes by a wide range when the demand was affordable housing complexes, which are not being built. So they missed the mark. So now that's going to definitely put pressure on them. You're going to see a lot of them come up for sale for a lot less money than they are today. So all these opportunities are going to unfold, and you can't tell me that the only person out there that's going to benefit is Warren Buffett sitting on $347 billion, because I'm sitting on cash. Chris, are you sitting on cash?
Absolutely.
Is it
more
boring?
than ever.
Boring as hell, isn't it?
Yeah.
You sit there and like you got nothing. But you know what? It's the greatest feeling on earth in a present time like now. So Chris, I'm going to let you take the stage for a little bit. Just whatever you want to say to the audience about infinite banking, how it's changed your life, how it's changed your client's life, and where you see it going into the future, good, bad, or indifferent. Because I have some negative views on where our industry could potentially go with some of the things I'm seeing right now. So what are your thoughts?
Yeah, I see it as part of the whole, right? I don't see it as the answer. I see it as like a key piece to throw extra gasoline on your wealth fire, right? Because, for example, I mean, you mentioned earlier, like treasury bills, right? I mean, you had a good section on that. What are they investing in? Treasury bills. And they get better rates than we do because they can buy it in bulk, right? They can get better offers, you can get better rates than what we get as a retail investor, you know? So a lot of that's helping. So like we talked about earlier, if the market's only supposed to average maybe 3 to 5% in the next 10 years, right? Depending on what happens, and that means ups and downs. Well, why not have my money in a place that's safe, earning 6% plus right now? You know, like to me, that's just a no-brainer. I'm changing my tune a little bit. I'm having people actually diversify their emergency fund into here first. So, because I used to get people years ago, they're all offense, right? Everybody's like about greed and making money. And so they're like, no, I want to take that money out immediately and use it. I'm like, no, actually, that first few years, especially when you have that net cost, because the insurance costs are front loaded in a whole life policy, just use your emergency fund. Use that to go in, almost like you're moving money from a bank savings account to a high yield savings account. Just move it over. You know, use that still, and use all the rest of your money to invest if you have opportunities to invest. I will say this, you know, when it comes to real estate, I think real estate investing is the best way to go. Whether you're an active investor or even a passive investor like I am now, I've stopped with active investing. I'm tired of it. So I'm more just passive investor. I like to invest with the active investors. But I'll tell you, I mean, like right now, there's still plenty of opportunity, but do not, if you're a real estate investor, don't go chasing after appreciation. I don't think you're going to see a whole heck of a lot of appreciation, in most markets. I know there's going to be exceptions, right? But don't bank on appreciation. I made that mistake before the last financial crisis, that I would do bad cash flowing deals because I thought appreciation would make up for my mistakes. That's not happening. I think you should really bank on cash flow. So look for cash flowing investments. And then the infinite banking is just a great way to store cash versus your 401k, where it's locked up in prison, or equity in your house, which is, again, locked up in prison. Notice that everything that a financial advisor tells you to do is to lock it up in prison. Get it out of your hands. It's not liquid. You can't touch it. Get in a place where it's actually liquid and available, because worst case, you keep it in your policy, right? You keep it in policy. If you don't know where to put your money right now, put it in your policy. Keep it safe. Let it be there for when the opportunities do present themselves to you. If you're not sure what's going to happen with Trump, great, join the club. None of us fully know what's going to happen. Great place to store cash, and then it's there to use it when you need it. So I think it's a critical piece. It's a critical, essential place to have your money. Don't put 100% all into alternative investments, even though you could make more money, yes. But I've had too many people tell me lately, they say, Chris, looking back, this is a 72-year-old dentist. He's like, Chris, looking back, I wish I had kept more money in my policy versus investing every single dollar I had into real estate. Because he's like, I've had some deals work and some deals haven't. And now what I have is I have no liquidity, but my cash flow is tight now, right? And so you want to have a good combination of both. It's like a 1-2 punch you can use together.
I think you're dead on, and that dentist probably had it right. Like, right now is the time to be very risk averse and really look at all the things you would normally invest in and say, is the juice worth the squeeze? And I agree with you. Active real estate. I mean, both of us have done our own fair share of real estate, and active real estate, it just burned me out, man. It literally sucked the life out of me. I'm lucky I have any hair on my head left from active investing, but I switched gears and now I mostly do private lending and, own a couple of rentals, but those rentals really are more passive than they are active because I have somebody watching over them and managing them, but it's still a little bit of work. But the whole idea is, like, everybody that is going to invest money needs to be a lot more cautious now than ever before in your investing career. And listen, I think I'm going to talk to all of you out there. If you're under 38 years old, please listen. If you're over 38 years old, you can kind of just remember this because you've already been through it. 38 years old or younger, you have no idea what's coming because you've never felt it. You've never seen it, and you've never, ever understood firsthand what is potentially going to happen. Therefore, you don't understand risk. You don't think there's risk. You don't understand that there is actually a lot more risk baked into everything you're investing in now than any other period of time, because you've never gone through a recession in a period of time in your life that would have affected you. That's crazy. This is the longest bull run we've been in history. So if you don't know the effect, well, then you just blindly are throwing money into things with no knowledge of what potentially could happen. And the advisors, to all you advisors, if there are any listening, shame on some of you. And I don't care what you think of me for saying that, shame on you. You went through the same training I did. You know exactly what I know. If you're telling your clients, just ride it out, you're giving terrible advice. Diversify them. Tell them to change their assets over. Go conservative. They're going to get paid sitting on the sidelines, but yet you're shoving them in these risky mutual funds, these risky ETFs, just because that's the popular thing to do and the easy thing for you to do. You still get paid that percentage on those assets under management. Why don't you actually manage the assets instead of just pushing that off on an SMA or pushing that off on, oh, you're in this for the long haul. It's just a paper loss. Ride it out. I've heard this too many times from our clients. And you know what, advisors? Got some news for you. We're coming for you. We're coming for you, and you're not going to like it because the truth is about to come out, so get ready. I didn't mean to use this platform for that, but you're the anti-advisor just like I am, so I'm just putting the warnings out there. And for all you clients, don't take the bait. A paper loss is a loss, whether it's on paper or real, because when you lose money, your money has to work twice as hard to get it back. Just look up the drawdown effect. But with what you were talking about, Chris, the infinite banking concepts. I like that. I love that idea of taking emergency fund money and just putting it in the policy and leaving it sit, because you're right. I always tell clients, I say, listen, the worst thing about what we do is there's going to be a period of anywhere between 2 and 4 years where every penny you put in, you're not going to have access to 100% of it. You're not going to get all your money back. And that's a terrible thing. But imagine this, you put the money into something, even if you just leave it sit there for 2 to 3 years, you're at a loss. But then after that period of time, let's call it 3 years, every year for the rest of your life. So I'm 47, soon to be 48 years old. Just imagine that. So from 48 years old until the day I die, let's hopefully think it's going to be in the 90s. It's a long time. Imagine that I gave up some gains and I gave up some joy and some FOMO for investing for 3 years. And I just kind of took it on the chin. But now, from that year straight through to the day I die, one thing and one thing only can happen. Every time I put money into this, I will take more out than I put in. And every year that goes by, every dollar I put in, I will take even more than I did the prior year and even more than I did the prior year. And that will continue on into perpetuity till the day I die. And then, this is the best part, folks. The day I die, there will be a tax-free death benefit paid to my trust, or we'll just say to my family, for a lot of money. But right now, it's in the tens of millions of dollars, tax-free, that will turn over to my family so that my family can continue to live the lifestyle they are, continue to give to our foundation and do donations and helps, child trafficking and, animal sanctuaries and all the beautiful things that we all would love to help. But just imagine that the money that we're going to be able to in the future help these beautiful things, even if it's, heck, maybe we want to save the bees, whatever it is, whatever floats their boat. The insurance company funded it all. Think about that for a second. And that insurance company that funded it all did it while still paying me a whole bunch of money. Literally, I can't say that it didn't cost me anything, because it did in those first couple of years. But because of compounding interest, the guaranteed nature of only a whole life insurance policy, that tailwind will never change. And if we then add one step to that stupid whole life policy, and that is the process, which is the single most important thing, and we learn banking. We learn how to be the bank. And we stop using banks for things like car loans. And we stop using banks for things like credit cards that we don't pay the balance off. And we stop using banks for things like buying real estate and taking a mortgage out. But we still take a loan. But every time we take a loan, we take it from our bank, the bank with our name on it. And every payment we make back to our bank, we get to keep and we get to compound on it. You lose nothing and you leak nothing. Your boat doesn't have a single leak and won't for the rest of your life. Folks, that is life-changing. And I will promise you that if you work with Chris, myself, or anyone in the infinite banking space, you will see the light. But it is against the grain, and that is the hardest thing, because it's totally different than everything you've been taught about money. And Chris, just give me one good story of a client that you've helped and what it's done to change their life.
Yeah, I'll talk about a guy because he's recently on my mind. He just recently passed away. A guy named Dan. He found me on another podcast that I was on. He started following my Money Ripples podcast, and he reached out and hired us to be a consultant to help him create passive income. Because he was told he had $1 million he saved up in his retirement plan. He was told by his financial advisor, well, now you're 60 years old, you want to retire, you can live on 3% or $30,000 a year. He's like, in California, that's like poverty. Why would I be a millionaire, a broke millionaire living in poverty? And so when we started to work with him, and yeah, we talked about infinite banking stuff too, right? But then we even said, let's take this money and start putting it in different places, self-directing your IRA and doing stuff. And he got into things with, multifamily, he got into things with, bought a couple of duplexes and rentals, turnkey, like you were talking about earlier, right? He did some things with oil and gas. And next thing you know, that $1 million was now paying him over $100,000 a year. And it got to the point where he was work optional, right? He worked because he wanted to, not because he had to. And so he started doing things that he did, Forest Service type stuff, right? Because he was military, but then he's like, hey, I'm retired from the military. I'm gonna do Forest Service and do different projects and just live life on his own terms. Well, that was for 4 years. He had that life back. And then just a few months ago, I found out he was at his desk, passed away of a heart attack, 64 years old, just passed away, And the reason that meant so much to me is that he gave him those 4 years, right? Because we don't know how long we're on this planet for. I know you and I are the same age. We don't know. We could be gone tomorrow. Hopefully not, right? But we just don't know. All we have is right now. How can we do kind of like what the sign says, live your life today, not tomorrow. And I think that's the key thing. What we're trying to teach is to liberate each and every one of us so that we are in a place where we do work because we want to, not because we have to. We get to do those things that light us up, to live and fulfill that desire and be able to live a mission that's bigger. I believe in God and that we're all on this planet for a reason. Like, what can we do to create a ripple effect to the lives of others and bless more lives?
And I know that's your podcast. You've been doing that for a while, Money Ripple. Tell me just a little bit about like that and like what motivated you to do a podcast. I mean, listen, I understand it. Like this is a giving thing. We make no money on this podcast, never have, never want to. I know some people do, but I don't. I do this because I want people to learn from others the things that I've learned. Like, tell me about Money Ripple.
Yeah, so I got the bug in 2007 when I was working with Garrett Gunderson together, and I would go on the AM talk radio show here in Utah, and then we decided to cancel that show. It was super expensive being on AM talk radio. Plus, I hate the fact you had like 7-minute segments. You had to right when we got on a roll, we got a commercial, right? So I started hearing about this thing in 2008 called podcasting, and I thought, well, that's kind of weird. I'm like, what is it? They're like, it's like online radio. I'm like, okay, that sounds cool. So I did that. My very first show was called Fire Your Financial Advisor, right?
Yes.
And yeah, that's when I became kind of the anti-financial advisor. Did that for 4 years, and then I stopped for a little bit. But then it was 2014. Yeah, 2014, I said, you know what? I want to do it again. Like I had so much fun because the truth is the reason I did the podcast in the first place was because I had young kids. I've got a blended family of 8 children. I figured with all these young kids, if I die before they're old enough to learn from the stuff I've learned, how can I pass it on? So it became a legacy aspect, but it also became like this frequently asked or should be asked questions for our clients, which would they would ask the same question every time. It's like, you know what? Save me the hassle. Go listen to this 15 or 20 minute answer to your question, and then we'll come back and talk about it. So I started to use it more as a way to teach, but it became more of like, what can I pass on? What can I teach and leave on this planet and help other people? But then, of course, it kept growing and growing. Even the Money Ripples podcast, and we've been now in our 11th year now, 11th season. Wow. And yeah, we're about to hit 1,000 episodes. So
1,000? Dude, I just
1,000. Yeah,
I just want to
hit that later this year in 2025.
Holy smokes. I had no idea you had that many episodes. Kudos to you, man. That's amazing.
You're like talking to you, I could not even tell you've ever done a podcast in your life. No, I was just kidding.
Now, so you got a lot of podcasts, but you don't just do podcasts. You have other channels that you share your knowledge and what you do on, right? Like YouTube. I mean, you're on there. So talk a little bit about your YouTube channel. Yeah,
really. We just kind of funnel all in one channel now into our Money Ripples channel, so it's, again, yeah, same thing. We'll do even little short videos and things like that are like very topic specific. So yeah, anybody who wants to follow us on YouTube, just look up Money Ripples with Chris Miles.
Yeah, we'll put it up in the description as well. So check out the podcast, Money Ripples, check out the YouTube channel. But Chris, let's go one step further. When you're working with clients, I know you work with them, you set up their infinite banking policies, but you do so much more. Can we just talk about that other side of your business of what you do? Because a lot of times when we talk about IBC, they think, somebody that just sets up the special design whole life. But you're different like we are, and you do a lot more on the back end. So let's talk about that for just a couple seconds.
Yeah, a lot of people ask me like, okay, I heard your bio, like you somehow retired twice by the time you're 39. And if you kind of put the pieces together, it's because I screwed up the first time, right? Like I retired the first time I was 28, had enough passive income that I didn't have to keep working anymore. But then the recession hit. I went from millionaire to upside down millionaire, had to dig out that $1 million debt hole, didn't go bankrupt. Although it would have been way easier if I did, it would be less to pay back, but I was just too dang stubborn, right? So I eventually got out of that debt hole. By the December of 2016, I was able to do it again, where now I had like over 10,000 a month of passive income. And so that's really what I help people do is how do you get enough passive income so that you become work optional, where you don't have to keep working the job. But like what I find is most people don't want to quote unquote retire. They want to become work optional. They want the option to retire. They want the option to take off a month or two if they want, but they're not, trapped into a job or in their business. And so that's what we really help people do is map out a blueprint and a game plan. Like we've proven it so many hundreds of times as we've worked with clients and done this over and over and over again, is that we just help figure out like, where's all your money? What can we do to get your money actually working for you? So you have to work so hard for it, right? So what can we do with it? If you got money trapped in your 401k, what do we do when you leave that job or whatever? Can we roll it over and do something else? Can we, put money in through infinite banking, then cycle that through to generate some passive income? Can we do some other stuff? So it's really like what you hoped a financial advisor would be able to do, but we're not financial advisors. We're not selling you anything. We're not offering any investments. Like, we're literally just strategists and connectors. We help you connect to those deals with vetted investments that we've curated ourselves. Doesn't mean it's guaranteed, but definitely reduce the risk and the time that you would take trying to find all these people, So like, recently I had a chiropractor where he's like, yeah, man, like I spend probably 10, 20 hours a week looking at real estate deals. I was like, that's way too dang much. Like, for that, you should almost be a real estate professional, And so we said, okay, here it is. Like, based on your situation, here's where this money could go and do this. Again, we're not investment advisors. We don't cross that line, but we say, you've got cash. Here's the different places you can put it in the alternative investment space, not in Wall Street, but in Main Street. And here's what you could do. It could be oil and gas. It could be franchises. It could be into different types of real estate, whether it's lending or syndications or whatever it might be. And so we really just kind of explore those opportunities, but narrow down the options based on your unique situation, your goals that you have, and then help you figure out how do you take action on it, protect yourself, build that asset protection as well in the meantime, and then, of course, keep your reinvesting, multiplying your returns by reinvesting that cash flow to not just compound interest, but compound your income to create perpetual passive income for the rest of your life.
I love that. I think one of the things you mentioned a couple of times in today's show is oil. And I think you're going to keep hearing more and more about that. The Trump administration keeps saying drill, baby, drill. Although oil prices have been going down, which isn't good for exploration and drilling and all that, and I've got another expert that's going to be on my podcast all about oil. But the one thing that will change the game for oil, regardless of where the price is this big, beautiful tax bill that they're trying to push through, which looks like it's going to stall out in the Senate, but they'll fix it up. And the one thing in that tax bill is bringing the bonus depreciation, the 179 depreciation, back to 100%, which it's about to sunset. It's at 40 now, and it's going to go sunset. But if they get this through and it goes to 100%, all I'm going to tell you, folks, is there's going to be a lot of really big money flowing into oil. If you understand taxes, tax deductibility, and what that means, you will understand that that is the pathway. So start getting your know, like, and understand on in the oil industry and what's going on there and how that will benefit you, not just from a tax side, but also the other opportunities that are there. And Chris, I know you do a lot with that, which is why I wanted to just mention that, because we're about to see a resurgence of what we saw back many years ago because of this. And even if the tax bill stalls out and doesn't go through, folks, I can assure you that some way, somehow, that will live on. And when it does, you're going to definitely want to start focusing on looking at oil. But with that being said, Chris, this has been awesome. It really has. And I love having people on the show that share the same viewpoints, that are doing the same thing, and just out there serving people at the highest level. And, I just think sometimes, like, we do God's work. We really do, because we're really out there just solving people's problems. And there's so few people, I feel, doing that these days. So just from the bottom of your heart, what would be just some of the best advice and parting words you could give to my audience?
There's always hope. I think that's the biggest thing, is that sometimes the answer and the hope that you're looking for can be easier than you actually believe it to be. But it's just knowing the right people, right? If you're connected with the right people in the right places, it's so much easier. Like, it makes it so much better. And so just realize, no matter how discouraged you feel, remember, I was over $1 million in debt at one point. Like, if a guy that was over, that's in the, like, literally $1 million broker than a homeless person, if he can get out of it, so can you. And so just know, I know a lot of you guys make great money too, but just know that there's always hope, that time freedom is the thing that you want, because you can be an instrument in the hands of God, and you can be doing some great work, when you have that freedom, if that financial and that time freedom in your life.
Well said, Chris. Well said. So, folks, we'll put it up in the description again. Money Ripples. Check it out. Check the podcast. Check the YouTube channel. Follow Chris Miles, and he will guide you right. With that being said, folks, I want to end just a couple words. One of the most important things in life, I talk to a lot of people that want to be successful, and the biggest thing I've learned, by not just following God and following all the things, but also Earl Nightingale, and that is this. If you want success, you need a worthy idea, but that worthy idea must be one you act on, and you must create your worthy idea. If all you do in life is conform to what other people tell you to do, what other people's failed dreams are, and just listen to them and just do as told, you will never live the life you want. Folks, the difference between success and failure is simple. It is creation. Go out there, create your life, create your dreams, because they are yours and they are a God-given gift. So go get them, folks. Thanks for joining us for this episode of the Money School podcast. We'll see you on the next one.